The United States is getting sick of China. It's sick of how China is able to enrich itself at the expense of the average American by pouring billions of dollars of low-quality goods into the country. And it's especially sick of how China has established itself as an economic powerhouse at America's expense, creating a multi-billion-dollar importing and exporting mismatch. It thought it had when the Trump administration implemented tariffs against China, which the Biden administration retained and even strengthened. Those tariffs were designed to stem the flow of Chinese products into the US while stimulating the American economy. But China found workarounds. It cleverly exploited loopholes and worked through backdoor trading channels to circumvent the tariffs and continue making billions of dollars from imports into the US. Not anymore. The US has finally had enough of China circumventing its tariffs and restrictions. Now it's sending a clear message to Beijing. It's time to get out of the US. In this video, we explore the trade wars that erupted between the US and China over the last decade, as well as the clever loopholes China has exploited to get its goods into America. We'll also look at what the US is doing to keep China out and what more work needs to be done for America to finally take control of its economy on its own terms. We start with the trade wars. China and the United States have a contentious trading arrangement. Each relies on the other, and neither is especially happy about it. China mass produces and imports goods into America, keeping the US stocked up with items it's not producing itself or attempting to replace American goods with cheaper alternatives. The US sends billions of dollars into China's coffers in return, boosting the economy of a country that many in the States view as a geopolitical enemy. We can see just how profitable this relationship has been to China if we check out the trade figures between it and the rest of the world since 2000. In that year, China exported $253.09 billion of goods, an impressive figure for sure, but a number that pales in comparison to what would come. A mere decade later, China has established itself as a trade monolith. President Xi Jinping's clever focus on turning his country into the world's manufacturing hub resulted in China pulling in a staggering $1.654 trillion in 2010, 6.5 times more than Beijing earned from its exports in 2000. Milestone after milestone fell from there. Just a year later, China cracked the $2 trillion mark, and it hasn't dropped below that number since. By 2021, COVID-19 was in full force, and China reaped the benefits, with its exports ballooning to a preposterous $3.554 trillion. The simple message to take away from these numbers is that China spent the last 2 decades turning itself into the world's trading partner, with the US buying more from Beijing than almost any other nation. In 2022, when China pulled in $3.717 trillion from its exports, the US accounted for $536.3 billion of those purchases. That was a 6.3% increase from the year before and 26% more than America spent on Chinese goods back in 2012. On the surface, it seems like a rosy relationship. China makes the goods, the US purchases them, each country enriches the other in its own way. So what's all of this talk about a trade war? When Donald Trump became US president, he quickly set his sights on China and its constantly growing exports. Trump accused China of unfair trading practices, a claim that he made repeatedly while on the campaign trail. At various points, he said China was taking advantage of the United States, with the influx of Chinese goods affecting American workers and businesses. He also accused China of being a currency manipulator and vowed to put an end to China's illegal export subsidies and lax labor and environmental standards. He said all of this against the backdrop of the United States being in a $365.7 billion trade deficit with China in 2015, an all-time high for America. China saw the entire situation differently. Trump's campaign rhetoric was a sign that the United States wanted to slow the country's rise as the world's foremost economic power, Beijing would claim. Far from taking advantage of the US, China was merely providing a service in which the US eagerly partook. Still, the tensions were there, and when Trump became president, he set about enacting a set of measures designed to make it harder for China to export so many goods to the US, the tariffs. A tariff is essentially a form of tax levied against imported goods. The idea is that this tax forces an increase in the cost of imported goods in the domestic market, making people less likely to buy them. China sells less as the tariffs make domestically produced goods more appealing to the American people. Ultimately, the goal is to boost the American economy by making Chinese goods less affordable, allowing American businesses to compete against products that were previously sold at much lower prices. Trump went tariff-happy when he became president. He imposed tariffs totaling more than $360 billion against Chinese manufacturers and retailers within the first 3 years of his presidency. China responded, of course. It implemented its own tariffs amounting to $110 billion on American-made products. But it was clear which was the most damaging of the two. With the US being such a massive customer to China, any tax placed on imported Chinese goods would hit Beijing in its pocket far harder than China's tariffs would hit the US. Trump implemented 3 rounds of tariffs in 2018, with a 4th round following toward the end of 2019. Examples included the American tariffs placed on musical instruments and meat, both of which were hit with a 15% duty during Trump's reign. Don't think for a second that Joe Biden reduced these tariffs when he came to power. Most were maintained, with the Biden administration even implementing new tariffs, such as raising the tariff on electric vehicles from 25% to 100% to build on what Trump started. These tariffs were nothing new. As PIIE points out, the US collected tariffs on Chinese imports during the Clinton, Bush, and Obama administrations, though at a far lower volume. These tariffs were also an indirect swipe at China. It's not Beijing that pays the tax on the goods it exports, it's the importer receiving those goods, who's then faced with the difficult decision of absorbing the cost, passing it on to the consumer, or simply no longer selling the product in question. The difference with Trump's tariffs and Biden's later is the sheer scale at which they were implemented. Importers had practically no choice but to pass on the higher costs created by the tariffs, again coming back to this idea of stimulating America's economy by making Chinese goods less affordable. After its own tariffs failed to prevent America's actions, China tried to negotiate. It's already pledged to increase US imports by $200 billion more than they were in 2017, closing the ever-widening trade gap between China and America. It's also supposedly taken action to strengthen domestic intellectual property laws, making it less likely that counterfeit Chinese products can enter the American market. It all adds up to what seems like a massive win for the United States. With tariffs, it gets to claim a much larger chunk of the money generated by importing from China than it previously did. It also puts China between a rock and a hard place. Beijing needs the US as a customer so much that it's willing to bend over backwards, in some respects, to keep it. At least this is how the trade war appears on the surface. But China is nothing if not a crafty economic foe, and it hasn't taken America's tariffs lying down. You may already get a sense of this if you remember the importing figures we mentioned earlier. US imports from China increased by 6.3% between 2021 and 22. The trade deficit also increased during that period. It was $382.3 billion in 2022, which is 8.3% higher than it was in 21. If anything, these figures make it look like the tariffs have the opposite of their intended effects. The question now is simple: how? The answer is that China has managed to exploit loophole after loophole to get around America's tariffs. It's taken advantage of the US and its trade agreements with other countries to circumvent duty taxes and still sell at high volumes. It's also used a rule intended to allow tourists to ship products to individuals back home to create massive businesses in a matter of months. In short, China found backdoors that, when combined with its legitimate trade to the United States, helped to make the country richer than it was even before Trump started ramping up the tariff pressure. We start in Mexico. The BBC recounts the story of a company named Manhua Furniture. Based in Monterrey, which is just 138 miles away from Texas by air, the business makes plump leather sofas and reclining armchairs, all carrying the Made in Mexico label. That's good for Manhua Furniture. That label means it can benefit from the United States-Mexico-Canada Agreement, or USMCA, which allows for free trade between Mexico, Canada, and the US. Manhua Furniture gets to be part of a massive free trade zone that encompasses 510 million people and has a $30.97 trillion economy when measured in nominal gross domestic product, or GDP. But here's the catch: Manhua Furniture isn't a Mexican company at all. It's a Chinese company built using Chinese money inside Mexico. China has been cleverly taking advantage of the nearshoring trend in Mexico, in which businesses hire employees from other countries to complete work on their behalf. In Manhua's case, that involves building an entire manufacturing plant in Mexico and hiring Mexican workers. The company gets to claim that its products are made in Mexico, when the reality is that the company wouldn't exist at all if it were not for Chinese capital. Manhua is far from the only Chinese company to use this little loophole. The BBC says that there are scores of them, all setting up in Mexico, both to reduce shipping costs and to get around the US tariffs placed on Chinese goods. The company's general manager, U.S China, highlights how successful this strategy has been, telling the BBC that "we hope to triple or even quadruple production here. That would be an impressive level of growth. given that Manhua already has 450 employees in Mexico. We're seeing the impact of Mexico's openness to nearshoring in its export figures. June 2023 saw the country export $52.9 billion worth of goods, which is an increase of 5.8% on the year before. If companies like Manhua follow through on their expansion plans, those numbers are likely to reach the hundreds of billions in no time at all. Of course, China is far from the only entity taking advantage of this nearshoring trend. Elon Musk is doing the same thing if his plans to open a Tesla gigafactory costing $10 billion just outside Monterrey is any indication. But with China, Mexico's nearshoring policies are getting close to creating a major security risk for the United States. That's according to Enrique Dussel of the Center for China-Mexico Studies at Mexico's National Autonomous University. Dussel says, "Mexico is putting up a big sign to China saying, 'Welcome to Mexico.' You don't need a PhD to know that this isn't going to end well for bilateral relations between the US and Mexico in the medium term." In other words, China has found a clever backdoor for getting around tariffs, but in exploiting that loophole, it's forcing Mexico into the middle of a trade war in which it wants no part. The US is already trying to close that backdoor in several ways. President Biden implements duties on steel and Mexican products made using similar metals that were poured or melted outside North America. The idea there is to ensure China's steel industry can't get around tariffs by melting steel before sending it to Mexico, meaning China's steel sector can't take advantage of the USMCA. But it's operating in a gray area, as Mary Lovely of the Peterson Institute for International Economics points out. Just because you see a Mexican manufacturer using Chinese inputs does not mean that they're violating any rules of origin. Mexico is winning big from this arrangement. Container trade from China to Mexico rose by 26.2% between January and July 2024, which followed a 33% increase in 2023. China is simply shipping more products, be that raw materials or actual saleable goods, into Mexico than ever before. Mexico gets to boost its export figures thanks to these imports, bringing more money into the country and improving its domestic economy. China gets to skirt tariffs and take advantage of North American free trade to sell without dealing with hefty duties placed on its products. Perhaps China's approach is going to trigger changes to the USMCA. That remains to be seen, but it's not just Mexico that China can use to sneak its products into the United States while avoiding costly tariffs. America's neighbor to the north, Canada, isn't immune to the issue. Now, China isn't able to use Canada in quite the same way it uses Mexico to get its products into the United States. Canada's labor costs are far higher than Mexico's, for example, meaning it's not advantageous for Chinese companies to set up shop in the Great White North. It's also worth pointing out that Canada's imports of Chinese products aren't growing as quickly as you might expect of a country falling victim to the USMCA loophole. In 2014, Canada spent $34.14 billion on Chinese products. By 2018, which is when most of Trump's Chinese tariffs came into effect, it was spending $44.13 billion. But we've seen almost consistent increases ever since. The total value of Chinese imports into Canada rose by nearly $10 billion in 2021 compared to 2018, and in 2022, Canada imported $65.92 billion of Chinese products, a clear record, with the number dropping back down to $56.93 billion in 2023. Despite that drop, there's a clear trend of more Chinese products entering Canada than there were before America put its tariffs in place. Many of those imports find their way into the United States. Canadian fulfillment centers are often used by China as intermediaries. One company in Toronto quickly pivoted to advertise itself as a China-friendly logistics company when America's tariffs hit. In these cases, China isn't building manufacturing plants itself. Instead, it's taking advantage of Canada not applying the same levels of tariffs as the United States. China exports the goods to a Canadian fulfillment center. That center then ships the goods onto American consumers, again allowing China to skirt around tariff restrictions to sell its products without forcing importers to eat a massive tax. All of this brings us to another question. What is the United States doing about these trade loopholes? The answer is simple: more tariffs. Only these tariffs aren't being imposed by the US. America is using its relationships with Mexico and Canada to gently push them toward creating harsher tariffs of their own to close the back door through which Chinese goods have flowed since the US tightened up its own tariffs. We saw this in Mexico in 2024 when the country implemented tariffs ranging from 5% to 50% on 544 products that apply to any country with which Mexico doesn't have a trade agreement. China falls under that umbrella. These tariffs, which are temporary, cover items including steel, footwear, plastics, chemicals, electronics, and textiles. Basically every major industry from which China's manufacturers profit is a target. Like the US, Mexico frames these tariffs as an attempt to reduce its trade deficit, which stood at $5.463 billion in 2023. But given that the United States is and remains Mexico's most important economic partner, trade between the two countries amounted to $745.6 billion in 2023, it's not hard to imagine that American pressure is paying off. America wants China's manufacturers to get out. Now it's playing a role in expanding tariffs outside its own borders to make sure that happens. The US is also directly pushing Mexico to prove that the products it imports are truly made in Mexico. That's the purpose of the steel duties we mentioned earlier. Biden has ensured that any steel imports from Mexico are subject to a 25% Section 232 tariff in all cases when the steel can't be proven to have been melted or poured in one of the USMCA countries. Canada is taking a similar approach to stem the flow of Chinese products into the country. Al Jazeera reports that it's going to follow America's lead in implementing a 100% tariff on Chinese electric vehicle imports. It's also going to place the same 25% tariff on imported steel and aluminium, reinforcing the notion that any metal products made in Canada need to actually be made in the country. Canadian Prime Minister Justin Trudeau says the new tariffs are designed to counter China's state-directed policies of overcapacity. But as we're seeing in Mexico, there's a good chance that coordination with the United States lies at the heart of those new tariffs. Further Canadian tariffs on Chinese solar cells and chips may also lie in the country's future. The US wants China to get out of its manufacturing sector, and it's working alongside Mexico and Canada to make that happen. These new tariffs, this time not of US origin, are designed to do just that, but there's a problem. The closing of these backdoors all relate to manufacturing and large-scale imports of Chinese products like steel, aluminium, and electric vehicles. These are products often imported into a country in deals worth millions of dollars, with the tariffs being designed to hit China where it hurts economically. However, it's not just these major industrial and manufacturing sectors from which China profits with exports into the US. The consumer-focused small goods sector is as much, if not more, of a problem. China enriches itself by selling small goods to customers by exploiting yet another loophole in American law. What's that loophole? 2 words: de minimis. You may be wondering how Chinese companies like Temu and Wish are able to survive in the face of America's rampant tariffs. After all, these are e-commerce companies selling consumer goods at rock-bottom prices. You may have used them yourself to buy products for cents on the dollar, compared to what an equivalent American product would cost. How is that possible when there are so many tariffs in place designed to help America's businesses? Surely these e-commerce companies shouldn't be able to sell such cut-price products because tariffs would add an import tax to them, except that didn't happen. The de minimis threshold states that any items imported into the United States that has a value above $800 is subject to duty, such as the import taxes imposed by America's tariffs. You may have already seen the problem here. Any item worth $800 or less isn't subject to these duties, as long as it's shipped to an individual, which is why companies like Temu and Wish are able to succeed. They can skirt around American tariffs by selling low-cost goods to individual consumers in low volumes. Most of these sales fall under the $800 de minimis threshold, meaning they're not subject to tariffs. Companies like Temu make hundreds of millions of dollars from carrying out thousands of these low-cost transactions every day. They're still selling in huge bulk, only with the caveat that each sale is tiny in comparison to that of an electric vehicle or steel order. The strategy works. After exploding in popularity thanks to its viral marketing in 2023, Temu wound up hitting revenue figures in the multiple hundreds of millions by the midpoint of the year. In September 2022, Temu had a gross merchandise volume, or GMV, of just $3 million. That essentially amounts to $3 million in sales made to customers. By May 2023, less than a year later, its GMV had hit $635 million, and that's mostly due to the company smartly taking advantage of America's de minimis laws. Temu is the big company taking advantage of the de minimis laws. There are many others, with the substantial $800 limit opening up a massive loophole through which many Chinese manufacturers and e-commerce retailers are able to shift products without worrying about tariffs. And this is a fairly recent loophole. Up until 2015, the de minimis threshold was just $200. It being raised to $800 hasn't just opened the door for legitimate Chinese companies like Temu to skirt tariff laws. As Reuters points out, that high threshold also makes possible the imports of dangerous substances like fentanyl or the precursor chemicals needed to make it into the United States. The situation is so dangerous that a host of Democratic House of Representative members, led by a trio of lawmakers named Rosa DeLauro, Tom Suozzi, and Earl Blumenauer, pushed President Biden to close it. The urgency of closing the de minimis loophole cannot be overstated, the trio said in a joint statement. In addition to pointing out the risks of consumers buying mislabeled fentanyl-laced pills online, they highlighted China and its use of the threshold. De minimis imports, particularly from China, also evade most existing trade enforcement mechanisms, including the Uyghur Forced Labor Protection Act and Section 301 tariffs used to hold trade cheats accountable. Just as it did with nearshoring in Mexico and working alongside fulfillment centers in Canada, China has found another clever way to evade America's tariffs. The US may want China to get out, but by leaving so many gaps in its own lawmaking, it's essentially inviting it through the back door. So we come to another question. What is the United States doing to close these loopholes and finally kick non-tariff Chinese imports to the curb? We've covered a few of its actions already. Working alongside Mexico and Canada to implement more tariffs stemming from those countries instead of the US is a solution on the manufacturing end of the spectrum. Those tariffs will clearly affect the flow of steel, aluminium, and textiles into Mexico and Canada. In the former's case, companies like Manhua Furniture won't be able to avoid tariffs by importing materials and furniture into the manufacturing sites set up in Mexico. They'll still have to pay, giving them pause for thought on whether it's really worth setting up shop in USMCA countries just to save a few dollars. Then there's the action on the de minimis threshold. President Biden listened to the House of Representatives lawmakers and fast-tracked an executive action designed to provide a temporary solution to the problem. While the ins and outs of the de minimis threshold are argued in Congress, Biden has made a rule excluding products from the de minimis exemptions if they would otherwise be subject to tariffs under either of two acts, the 1962 Trade Expansion Act or the 1974 Trade Act. It's the latter that's the big hitter here, as the Trade Act covers around 40% of all imports into the United States, including around 70% of Chinese textile imports. Further regulation is also being discussed. Specific actions will be taken against shipping companies like Temu and the Chinese fashion manufacturer Shein that prevent them from drop shipping their products to a customer's doorstep. That's another way these companies use the de minimis threshold. It applies solely to products shipped to an individual, which is what these Chinese retailers do. Rather than going direct to a doorstep, these packages would have to arrive at an American port and contain full information about their contents. Importers will also have to file with the Consumer Product Safety Commission to demonstrate shipping compliance and argue for the de minimis exemption if they believe it applies. That more laborious process forces these $800 or less packages to go through a more defined customs route that checks what they are and if tariffs should apply to them. Combine those with stronger tariffs implemented by Canada and Mexico, and you have the United States creating a volley of measures, all designed with one purpose: reducing China's influence over American trade. There's one final question to ask. Will all of this be enough? Brookings argues that it may not be. Or at least America's combination of leaning on USMCA members and closing the de minimis loopholes are just the first of many steps it needs to take to get a better handle on its trade relationship with China. It argues that coordination is key, pointing to China's use of Mexico and Canada to backdoor products into the US as a major problem. Tariffs from both countries need to be stronger to the point where they match those implemented by the US. We're seeing evidence of that starting to come into place with Canada's electric vehicle tariffs and Mexico's temporary tariffs on steel, textiles, and so on. Other measures could include encouraging Mexico to add inbound investment screening processes that are unfavorable to China. The US could also take steps to ensure that electric vehicles of Chinese origin can't benefit from the $7,500 IRA tax credit applied to all electric vehicles made in North America. Perhaps we'll see such measures taken in the future. For now, the US is sending a clear message to China. It's had enough of the trade deficit. It's had enough of Chinese products flooding into the US, so the US will continue to strengthen tariffs while encouraging its USMCA trading partners to do the same, all while closing up the de minimis loophole that has placed so many small American businesses under threat. Will these measures work? Let us know what you think in the comments, as well as what else you think the US can do to reduce China's economic impact on the country. Should America offer more incentives to domestic manufacturers and retailers? Could it be even harsher with its tariffs or similar measures to hit China, where it really hurts economically? Share your thoughts below, and thank you for watching the video.